Okay, let's get this started. Good morning and welcome to today's Tuesday Market Outlook webinar. My name is Prakash Vijayanath. I'm a senior analyst here at OptionsPlay, and today I'm going to be walking you through my thoughts and analysis on the current market. So, before we get started, just the usual disclaimer. The types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by OptionsPlay or solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. Our agenda for today, kicking off with the major equity indices, highlighting some key levels. We are in a, let's say, relatively more quiet week during this earnings season, but next week we do have big tech earnings with Amazon and Apple, etc. reporting, so that'll be a bigger market mover. So right now I do expect some more consolidation or neutral price action heading to next week. So from there, we'll be moving on to fixed income and commodities. We'll take a look at the sector rotational model, highlighting which sectors are outperforming and underperforming the overall market, taking a look at some subsectors as well, just the one that I have for you today. And we'll end today's webinar with some bullish and bearish market observations. So the S&P 500, look at the SPY ETF, and we can see there is some neutral price action here over the last few days. We navigated through big bank earnings. That went quite well on the first week of earnings week, and that saw price actually break above that 444 level. Price continued to rally to around this 455, 454, 455 area, and it's also a major area of weekly resistance. As you can see, this level on the weekly time frame has provided support and resistance in the past. However, I don't think it's going to be too much of a major area if next week's earnings go quite well. I do expect price to break easily back above this level, if not either next week or even before that. And, the S&P 500 revisiting those all-time highs pretty soon back at 480. Now, when it comes to the macro perspective, regarding interest rates, markets are not pricing in a more dovish Fed. We know that inflation, especially labor inflation, is coming down quite nicely, a little bit better than expected, and consumer spending is still high despite higher interest rates. So that is, a sweet spot for equities because consumer spending is high, equities tend to rally. But at the same time, we are also going to see most likely the interest rates come down sooner than expected. That being said, we do have the Fed meeting this week, and all eyes will be on that. Not necessarily the 25-point hike that's been priced in a long time ago, but what Jerome Powell will say and the forward guidance for where interest rates could potentially head and when they are expecting to start cutting interest rates. So that will be the bigger market mover for this week. But from an earnings perspective, it's nothing too crazy this week. It's mostly next week that's we're going to see earnings volatility. Overall, for the S&P 500, I am clearly bullish. We do have minor support at 444 if price does for some reason pull back. But overall, you can see how much momentum on the weekly time frame there is here with equities approaching an overbought condition, but not yet quite there. And we know that with equities, when they're on a bullish rally, they tend to be overbought, or the major indices, I should say, they tend to be overbought for an extended period of time. So it looks like we're kind of starting that process once again. Moving on to the NASDAQ 100, looking at the QQQ ETF, so we have seen price pull back a bit more. So more recent days, we are seeing the S&P outperform the NASDAQ. And, that's, I wouldn't say it's surprising, but it's quite interesting to see because the NASDAQ was providing a bit more leadership for the major indices, especially due to its exposure with the big tech names and obviously higher growth names in the early bull markets that we're currently experiencing, or we've seen signs of that as well. So that's why we've seen the NASDAQ 100 outperform. However, we are seeing a slightly more pullback. But that being said, it's still not breaking bullish structure. As you can see, price is still above the 21-day exponential moving average, which just speaks to how strong this rally has been for the NASDAQ 100. I mean, on the weekly time frame, it absolutely shattered this 320 area a few months ago and very quickly rallied back up to 380. Yes, we're seeing a rejection there, but I don't view that as a reversal that much lower. I think this is going to be a bit more of a pullback. We could get a steeper pullback, but this is in and around the price range where you're looking at for the pullback or a potential continuation higher. Again, all eyes will be on next week's earnings. That will have a huge impact on where the NASDAQ 100 will rally to, if it does rally. In terms of upside resistance or upside targets in the short term, it's really all-time highs, between 400 and 410. That'll be the area that I'll be looking at to the upside here for the NASDAQ 100 should it continue higher. Downside, limited to this 370 area, which was a breakout level a few days ago. But if it breaks below that, you also have a 355, 360 level. So there are multiple areas of support. Don't forget the dynamic support between this 21 and 55-day exponential moving average. As we can see, price has found support near these exponential moving averages in the past, especially with this bullish trend. So plenty of support to the downside if price does decline, and there's also plenty of room to the upside. And therefore, again, like the S&P, my bias is a little bit more bullish here for the NASDAQ 100. Okay, IWM, looking at the Russell 2000 ETF. So we're looking here at small caps. So small caps, last week we were, obviously talking about the fact that price broke above this 188 level, which was huge. That's a 38.2 fib level. I did crop that out a little bit, and I apologize for that. But that's the 38.2 fib level, major resistance zone as well. And it was looking like price was reaching our short-term target of 200. Didn't quite get there though, running into some resistance at 198. But again, this bullish trend doesn't really look like it's over. Bit of a pullback, finding some intraday support yesterday at 194. And does look like it's going to be setting up for, after this pullback, a continuation higher. 200 will be a resistance level, but the major level that we're looking at is a 23.6 fib level at 210. That was a major area of support for basically 1 year for small caps, and was also a major resistance level as well. So that's the key area that we're looking at, but 200, again, strong psychological level, and we shouldn't be ignoring that to the upside. Okay, moving on to TLT. So TLT was showing signs of strength. Definitely a lot more volatile in the last few weeks, as you can see. But what we saw was price, very quickly declined to 100 or 99 support. And then it looked like it was going to break down due to the bearish momentum behind this move. However, we haven't quite seen that. Instead, we saw immediately a reversal higher, price reaching almost 104. So 104 was the other resistance level that we've been looking at over the last couple of weeks. Also didn't quite get there. And now we are seeing price react to the 55-day exponential moving average. Very bearish price action here in the last few days. 3 red candles, all rejecting the 55-day EMA, and price to open lower this morning. It does look like price is going to be revisiting this major support level. So thesis is still a little bit to the downside, but I would say there's a hard level of support here at 100. So if you are going to go bearish on TLT, very short-term trade, I do not believe that this level will be broken anytime soon. But then again, it depends what happens here with interest rates. Moving on to the dollar. So the US dollar has, recovered very quickly from what was a significant decline in just a few short days. We saw price breaking below the $101 major support level, reaching just below 100. Finding some support there, looking like it was going to be a bit more of a retracement higher before another move lower. However, the key bit of price action that's happened in the last couple of days is a break back above 101. And that's significant because what we saw was a breakout, an intraday retest of 101, and a continuation higher. So this, when you see price action like this, normally you look for an impulse move followed by a retest to a previous area of support turning resistance. But when that resistance level gets invalidated, there's plenty of room to the upside here for the US dollar. And it does indicate that a more full-on reversal may be on the cards here for the US dollar. That being said, I do note this 102 level as well. That was a previous area of support that could also potentially turn into resistance. So we could see price rally back up to that level before running into resistance once again. Now, the initial impulse move by the dollar to the downside was caused by markets pricing in a much more dovish Fed with inflation data coming in softer than expected. And that is why we have seen naturally the dollar decline, in a more dovish environment, or when markets are pricing in a more dovish environment. So this reversal higher is a little bit surprising. And that's why, last week even, I thought that was just going to be a bit more of a retracement before continuation lower, or maybe, consolidation at around this $100 level. So when it comes to the US dollar, I'm not going to really have too much of a bias here. I'm going to wait and see, going to play the waiting and see game, because once it gets to 102, that's the key area. At this bearish price action, that could initiate a continuation lower here, or revisit back down towards either 101 or the $100 level. But if you see a breakout, there's plenty of room to the upside for price to rally back to 103.50. Okay, taking a look at gold. So gold, off the back of a weak US dollar, actually saw price rally back up to 184. And gold is under pressure due to the fact that it's a safe haven. We're very much in a risk-on environment, and therefore investors are rotating out of safe havens like gold and into equities, and into both names as well within the equity space. So we did see, with the US dollar declining, gold moving higher, reacting to 184 like we discussed last week, and we actually have seen bearish price action since we spoke. So it does look like this 184 could be a ceiling here for gold in the short term. And as a trade, it's going to be difficult because the move lower is also helped by the fact that the US dollar has recovered. But the big question is the US dollar reversing, or is it just, a minor recovery before continuation lower? If it is reversing higher, we could see a continuation lower here for gold. However, if it's more of a short-term retracement followed by consolidation for the US dollar, followed by a decline, we could see price, revisit this 184 level. Risk to reward does favor the downside from at 184, but again, very much dependent on what the US dollar does as well. I would wait for price to actually reach 184, look for bearish price action, and probably opt in for using a call credit spread. So selling a call vertical, that is a neutral to bearish strategy. It doesn't require the underlying to move significantly lower for it to be profitable, and it does take advantage of neutral price action using theta in your favor. So that's how I would look at gold. Not necessarily bearish 184, but price respecting 184 as resistance should it revisit that level. Moving on to oil, looking at light crude oil futures. So the key level to be looking at on the daily time frame is 74. Major resistance level on the daily for a few weeks. What we saw quite recently was a breakout, a perfect retest, big engulfing candle there. Well, not technically an engulfing candle, but very bullish price action, I should say. And a continuation higher here. So it does look like price is going to be revisiting the low 80s, 82, 83, major resistance. And this comes off the back of supply cuts. That's quite simply the reason why it is rallying. And supply cuts tend to really offer the short-term boost here for oil prices. When you look at the longer-term fundamentals, oil is still under pressure. Chinese data is still coming in quite weak. And with China being a significantly big economy, it means that oil demand will be impacted if Chinese data comes in weak. So recession fears are still very much in play in the longer term. However, in the shorter term, we are seeing some tailwinds here due to supply cuts from oil-producing nations. Taking a look at sector rotation, we have 4 sectors in the improving and leading categories and 7 in the lagging and weakening. So the leading categories, we have discretionary and technology. Both sectors actually losing out on some momentum here relative to the overall market. And that makes sense, right? Because if you remember, the S&P is outperforming the NASDAQ over the last few days. And the S&P provides a much better gauge of the overall market, whereas the NASDAQ is more concentrated within technology names and discretionary names as well. And that is why we are seeing that underperformance here in these sectors relative to the other sectors that are actually finding support. So we have energy moving higher with a lot of momentum here, thanks to higher oil prices, materials, real estate. We have our defense sector is doing quite well on a relative basis, but I still believe that they're not the place we want to be right now. I think there's better opportunities, there's better sectors to be looking at, such as financials and industrials, which are in the improving category, rotating a little bit towards the leading category week on week. Financials have navigated through the earnings season quite well. The major banks have performed quite well during earnings, so there isn't too much There's a bit of a clear road ahead for the rest of the earnings season for financials, and industrials also performing quite well. Communications continuing to weaken, but still not very bearish just yet. Overall, the markets are moving higher as a whole. So this is only measuring relative performance. So even if technology moves higher, if it's not moving as high as the other sectors, it's going to be that momentum is going to be declining, and therefore you will see the sector rotate lower. So it's not necessarily a bearish signal to see these sectors in the leading and even weakening categories move lower. But it does indicate that we are seeing some rotation back into the rest of the other sectors, and it's less so concentrated within these within the sectors in the leading category. Okay, so taking a look at XRT, the retail ETF, and this is a bullish idea that I had for you. I think it was last week or 2 weeks ago, where we saw a breakout above 64. And that for me broke and invalidated this bearish structure on the daily time frame. On the weekly time frame, things are still quite neutral. After this initial bearish move, we've seen price pretty much form a range bound market with 76 support and around, let's say, 56 resistance. 56 support and 76 resistance. But on the daily time frame, we are seeing an opportunity where price broke above, came back to retest, and is now moving higher. The recent price action was a little bit bearish. We've seen a bit of a pullback, but bullish structure remains intact, and price is still above its 21-day exponential moving average. There's some weekly resistance here at around 67, 68. But there's a lot of underlying momentum here behind this move, and I do believe that there will be a breakout above this level and a continuation higher here for XRT back to 76, especially with consumer spending still going quite strongly here. Okay, moving on to GM. So GM is a bearish idea that I have for you today, and I'm really focusing on the weekly time frame. So initially we had a strong impulse move to the downside. We have some support at around 32.50 and resistance at around 40 to 42.50 here, this resistance zone. Price recently has rallied back to this level, and it's already showing some bearish price action on the weekly time frame. So the way I'm looking at this is, even if we do get a bit of a move, a slight move higher here on the daily time frame, it's still within this range, and the risk reward does favor the downside. However, I'd be very conservative with this downside view on GM, especially when markets are continuing to move higher. And the trade structure that I'd opt in for, again, would be a call credit spread, just to take advantage of the more neutral price action here for GM. Because even if it doesn't move lower, as long as it respects this 40, 42.50 level of resistance, that call credit spread still be an optimal strategy. So GM, let's see how this plays out, but neutral to bearish outlook here for today. Moving on to AMD. So AMD was a bullish idea a few weeks ago. And the reason it was bullish on it was because we had a strong gap up higher, and then we saw a nice retest back to 108, providing a very good bullish entry point, and price did move higher. I mean, if you took the trade from that 108 level that week that I spoke about it, it did still reach 120. However, looking at this trade again, when it's running out of momentum, and therefore it's not a very good debit spread. A credit spread would work a bit better in these conditions. It's still very much in line with our bullish thesis of staying above 108. However, the lack of momentum to the upside indicates, again, a put credit spread might be the best use here, which is a bullish to neutral strategy. As long as price, if your short strike is at 108, as long as price is above 108, and it doesn't invalidate the thesis of breaking below 108, that trade would be profitable. So AMD, not a debit spread, maybe a bit more of a credit spread, even though we still have a bullish thesis here for this trade. That being said, the weekly time frame, I'm not liking the way it's moving over the last couple of weeks. As you can see, the last few weeks has seen a double rejection of 120, and that does look like it's gearing up for a move to the downside. So if you did take this trade a few weeks ago, I think now would be a good time to close it if you are conservative. However, if you want to play AMD on the daily time frame, it does look good. However, on the weekly time frame, I'd be a little bit more conservative here and potentially sit on my hands for this one. Moving on to Moderna. So Moderna is a new idea that I have for you today. And as you can see, price on the weekly time frame is at a major level of support at 120. This is a weekly support level. So when I look at this chart, on the weekly time frame, it did decline back down to the support level. However, on the daily time frame, it's not really showing signs of capitulating higher. It is respecting 120, yes, but price action is still quite neutral. So, when it comes to the fundamentals of Moderna, they are expanding their product range. Before they only had the COVID vaccine, and they've made, I'm talking about, months and months ago, they already made a decision to expand their product range. So the fundamentals aren't too bad. But I would view Moderna here at current levels as a good risk to reward bullish entry point, but for a longer term holding, even considering purchasing the shares outright and holding, because we are still in a big range with, let's say, 180 as resistance. And with price at support here, it does provide an ideal risk to reward bullish entry point, targeting either 160, previous swing level, or even 180. But yeah, as an options trade, you probably want to opt in for a longer duration debit spread, or simply buying these shares outright. Taking a look at PayPal, which was a bullish trade idea that I had for you a few weeks ago when price broke above that $70 level. So after price broke above this, we saw price continuing to rally and has since pulled back to 72, retested that, which was also a previous area of support, as you can see, and it's bounced higher a little bit yesterday. So that provides another good entry point for continuation higher here for PayPal, and really just reaffirms our bullish thesis. 78 could be a short-term target point. However, looking at the bigger picture, it could be, exposed to PayPal up until mid 80s, even low 90s. I think there's plenty of room to the upside here for PayPal. From a valuation perspective, it's a lot better than it was, during the pandemic. Much more modest valuations, and fundamentals don't look all that bad. It's just that it had such a big decline during the bear market due to how overvalued it was at that time. However, PayPal, I do think, has a pretty decent bullish thesis here from both a technical and a fundamental perspective. So taking a look at a name that we've looked at for quite some time, and that is BMY. So BMY, we had a bearish trade here a few weeks ago, and I think it was last week we had said, it'd be a good time to take profits, or at least partial profits, and let the rest of the trade run here. And if we see bullish price action, immediately close. Well, what happened was we saw, with our bearish thesis at 66, the trade went very well in our favor, but it didn't quite reach that $60 level that we were hoping to. So even if you took partial profits and closed the trade for, let's say, the rest of the trade for partial profits, we saw a rally here back to this 55-day exponential moving average. And with that in mind, as you can see, the overall trend is still bearish. We've seen a rejection of that 65 level and the 55-day EMA yesterday. And this is where, depending on today's price action, if we see bearish price action, we could re-enter the bearish trade for continuation lower. Especially because the overall trend on the weekly time frame is still quite bearish. Price reacting to this area here of support, not quite there yet, that $66 level. So even if it does rally a little bit more to 66, that would be a much better risk to reward bearish entry point. But either way, definitely on my bearish watch list here, BMY. And with that, that is all I have for you today. Thank you so much for joining me, and I hope you all have a great trading week. I will see you next week for another market outlook. Goodbye, everyone.